We're going to apply our definition of expenses, which is the fifth element of accounting. We're going to apply it to some examples to say why something is or isn't an expense. So to do that, we're going to need to know our definition. So an expense has three parts. The first part is it's got to be an overall decrease in assets or an increase in liabilities. Two, it's got to decrease owner's equity. And three, it's got to arise in the course of the ordinary activities of the business. And just a couple of little notes. We said, look, it's overall assets need to decrease or overall liabilities need to decrease. And overall owner's equity must decrease. And just this last part, it just means it's got to come from an ordinary business activity, something that's not unusual or perhaps a transaction with the owner. And based on that, that rules out drawings when the owner takes money from the business or any asset. So what we'll do is apply this definition of an expense, these three parts, to a few transactions to figure out whether something's an expense. So let's take the first example. A business pays $500 cash as a loan repayment to the bank. Is that an expense? Well, to answer this, the best way is just to use your accounting equation. Your accounting equation will guide you through this definition so you can answer this question. So let's take this one. We paid $500 cash. So we have cash as an asset that's gone down. Something else must happen, otherwise our accounting equation doesn't balance. And what it is in this case is our liabilities, called a loan, also go down by 500. And that's our transaction. So let's balance this up. Overall, assets went down 500. Liabilities went down 500. And owner's equity was 0. Okay, so all we ever got to do is go through our definition of an expense. If all three things are true, then we've got ourselves an expense. So let's start with the first one. Is there an overall decrease in assets? There is. Let's actually go down to this one. Did it occur during the ordinary activities of the business? Yeah, loan repayment's very ordinary. That happens all the time. That's this bit. This bit is not true. There is no decrease in owner's equity. We can see that's 0. So if there's no decrease in owner's equity, then overall this is not an expense. So let's take a second example then. Let's look at our definition here and go, well, what about this one? A business pays $2,000 cash to purchase inventory for resale later on. So let's look at our accounting equation. We have an asset called cash, which has gone down because we've spent some money. What did we get with that money? Well, we actually got another asset called inventory, and that's gone up by 2,000. There's nothing here or here. So if we balance that up, this is 0. Liabilities are 0. And owner's equity is 0. So let's look at our definition. Does this meet the definition of an expense? Well, no. First of all, there's actually, or we could say it does in this sense, it does occur in the course of the ordinary activities of the business. But does it decrease assets overall? Well, one asset went down, called cash, but overall, no. It just stayed at 0. And that is not a decrease. So I guess the rule here is if one asset goes up by one amount and one asset goes down, that is not an expense because overall assets did not decrease. And lastly, it can't be an expense because there is no decrease in owner's equity. So we would say buying inventory is not an expense, it's an asset. What about this one? Let's take the definition and apply it to a business pays $4,000 cash for this month's rent. Okay, so what have we got here? Let's look. We've got less money. We've spent $4,000 cash. Now, when we rent something this month and pay it, we're going to use the property, all the economic benefits are gone. It's not like we've got another asset. We're not paying off a debt. So that actually is going to be an expense, which will decrease owner's equity. But why is it an expense? Well, let's have a look. Let's go through our definition. First of all, assets down 4,000. Liabilities, nothing. Owner's equity down 4,000. So, did assets decrease overall? Yep, they went down 4,000. Was there an overall decrease in owner's equity? Yes, there was. Is paying the rent each month, does that arise in the course of the ordinary activities of the business? Yes, it does. So you could just say it meets the three parts of the definition of an expense, and that is why it is an expense. Let's look at the accrual basis concept. That was one of our accounting assumptions. So net profit is calculated by revenues earned. They're recorded when they've been earned, not necessarily received, minus expenses incurred. And that just means they are recorded when they are incurred and not necessarily paid. Incurred just means used up, consumed. Let's just look at this concept. Don't worry about revenues. We've done that in another video. This bit, expenses incurred. It doesn't matter whether the cash has been paid. So we've got our definition here. A business purchased $3,000 inventory on credit with 30 days to pay. So accounting equation wise, what do we got? Well, we've got an increase in an asset called inventory. That's gone up. What else happens here? Well, in this case, we haven't paid for it yet, so we've actually got a liability here. And that liability is called accounts payable when we buy inventory on credit. That's gone up 3,000. So overall, assets up 3,000. Liabilities up 3,000. Owner's equity 0. So this cannot be an expense. We could argue that there is a decrease in assets or an increase in liabilities. Well, hang on, assets didn't decrease, they went up. Yes, but liabilities went up. So far, that actually does, at this point, meet the definition of an expense. We do have an overall decrease in liabilities. Okay, did it arise in the course of the ordinary activities of the business? Absolutely. Buying stock is a key thing we'll do many times each month. But it's not an expense because there is no overall decrease in owner's equity. It's stayed at 0. So we would have to say this is not an expense. Let's just take kind of a similar example. We'll say this month's phone bill, but we'll say this was paid on the 14th. Or actually, it hasn't been paid. It will be paid next month. So for this month, is the phone bill an expense? We haven't paid it. Does that matter? Well, let's have a look. First of all, we have a phone bill, we haven't paid it. That is a liability called phone bill payable. It's gone up by $400. So I guess we just want to think, well, did we get an asset from this? No, it's not like we, the phone bill, the data and stuff for this month, it's gone. It's not like we have it for the future. So there's no other asset. There's no other liability going down. So this will be an expense, just called phone expenses or internet expenses, whatever. And that makes owner's equity go down. But why is it an expense? Well, let's look. Assets went up 0. Liabilities went up 400. Owner's equity went down 400. This balances because 0 equals 400 minus 400, which is 0. So that's good. But we're going to say this is not an expense. Let's go through our definition. Did it decrease assets? No. But it did increase liabilities. So that is true. Is the phone bill and using the phone and the internet each month an ordinary business activity? Yes. Oh, sorry, looking at this one. Does it decrease owner's equity? Yes. It's going to decrease owner's equity $400. Okay. And is it an ordinary business activity? Yes, it is. I guess we now need to say the 3 parts of the definition are met. So this is an expense. And the rule we've learned is it doesn't matter that no cash was paid. So we can see nothing happened here. Money didn't go down, but it's not about that. It's about whether the expense was incurred, not whether it was paid. Just a couple of little examples to finish off with. We'll just do the business paid the $3,000 it previously owed to a supplier for inventory it purchased on credit. Is that an expense? Let's have a look here. Well, what have we got less of when we pay $3,000? We've got less of an asset called cash. However, this can only be an expense if it makes owner's equity go down, and it's not going to do that because when we owe a supplier for inventory, that's called accounts payable. We did owe them $3,000. We're paying them back, so now we don't owe them $3,000. So this is going to go down. So we've balanced this up. We've got assets down $3,000, liabilities down $3,000, owner's equity 0. So our accounting equation balances. Just stepping through our definition. Was there a decrease in assets or an increase in liabilities? Yeah, there was. Assets went down. That just says or. It doesn't say both have to be true because liabilities actually went down. They didn't go up. But that doesn't matter. It's just one or the other has to be true. So that's cool. Did it arise in the course of the ordinary activities of the business? Yeah, it does. Paying back people we owe money to is very ordinary. That happens all the time. But does it result in a decrease in owner's equity? It didn't. All it did was actually lower a liability. So overall, there was no impact on owner's equity. So when you pay back an accounts payable for money you owe, that is not an expense. Let's just take our last example. It's all about the entity concept where we said the business and the owner are separate entities. So we get the owner here as one entity, does not equal the business as an entity. So they can do transactions with each other. So the owner can give the business money, car, property, whatever. Any type of asset, that's called a capital contribution. And likewise, the owner can take out money, car, property, inventory, whatever, any type of assets, and that's called drawings. So let's have a look at that and say, are drawings an expense? So our final example, the owner of a business withdrew $200 of inventory to give to a relative as a birthday gift. Is that an expense? Well, let's look at our accounting equation. Now, the taken out inventory doesn't have to be cash for drawings, but whatever it is, the owner's taken an asset. So in this case, an asset is going to go down called inventory. So does another asset go up? Does another liability go down? No. What happens here is the owner is literally withdrawing their equity or their capital. So drawings are a negative owner's equity account. They make owner's equity go down. So we balance this up. Assets down 200, liability 0. Owner's equity down 200. Is this an expense? It's looking a lot like it because let's look at our first part of the definition. Was there a decrease in assets? Yes. Was there a decrease, an overall decrease in owner's equity? Yes. So far so good. The problem with this is this isn't an ordinary business activity. This is just the owner withdrawing their capital. So even though this looks like an expense based on the numbers, we say drawings are not an expense because it fails this third part of the definition. It's just the owner withdrawing their capital. There's no expense incurred by the business. So we would argue that did not occur in the course of the ordinary activities of the business.